On behalf of JM Financial, we extend a very warm welcome to all of you at the conference call of JM Financial Limited to discuss our financial results both for the second quarter and first half of financial year 2018-19. I hope you have had a chance to go through our presentation, press release and results. We have updated the same on our website and also on the stock exchanges. I have with me today Manish Sheth, our Group CFO, Shashwat Belapurkar, Head of our Fixed Income and Lending for both Commercial and Real Estate and Corporate, Anil Bhatia, CEO of our ARC, Subodh Shankar, CEO of our Investment Advisory and Wealth Management Business, Sonia Dasgupta, Head of our Borrowing, and Gitanjali Mishandani, Head of Origination for JM Financial Credit Solutions Limited. As you would know, we adopted Ind AS reporting from this financial year. As per Ind AS, considering that the views of the management have precedence over the erstwhile risks and rewards model, our segments have been reported based on management's evaluation of financial information for allocating resources and assessing performance. Accordingly, our segments have been reclassified into the following. The first segment is the IWS segment, which stands for Investment Banking, Wealth Management and Securities Business. This includes both the fee-based and fund-based activities for clients in this segment. We look at this segment as an integrated business serving the capital markets needs of all our customers. The second segment is our mortgage lending segment. This segment includes both our wholesale real estate segment, which includes our construction finance vertical, and also our retail mortgage, which includes home loans, SME loans, and education institution-based SME loans. The third segment is our distressed credit business, which includes the asset reconstruction business. And the fourth is the mutual fund business covered under asset management. I shall now provide an update on the performance of our businesses, post which Manish will take you through the quarterly financial numbers, and then we can open the floor for question and answers. Our consolidated revenue for the first half of FY19 stands at 1,828 crores, up approximately 22% year-on-year. Our PAT for the first half FY19 is at 306 crores, up approximately 10% year-on-year. Our consolidated loan book stands at 17,100 crores, up approximately 38% year-on-year. 65% of our loan book comprises of wholesale mortgages, which is approximately 11,200 crores. The book has registered a year-on-year growth of 46%, and a Q-on-Q growth has been flat. The capital market group lending book is 2,500 crores, comprises of 15% of our total book. It has also registered flat growth Q-on-Q and a 16% growth YOY. The corporate lending book stands at approximately 3,000 crores. It's 17% of our total book and has registered a year-on-year growth of 25% and a Q-on-Q growth of 18%. The retail mortgage book is around 450 crores, which is 3% of our book, and has registered a growth of 13%. The gross NPA ratio of the lending business is at 0.54%. Our consolidated debt equity stands at 2.61 as of September 30th, 2018. And in the first 4 weeks of October, we have repaid approximately 1,800 crores of borrowing, and therefore our current debt equity stands at 2.3 times as of October 25th. Our borrowing mix as of October 25th, 2018 stands at 35% short-term borrowing and 65% long-term borrowing. Our short-term borrowing is primarily against short-term assets such as high-quality liquid assets in the capital markets segments and short-term maturities on our loan book. Before we share the quarterly financials and the first half financials, I will take you through a very brief update on the performance of each of the group's verticals. We start with the investment banking, wealth and securities business. For the first half, we had revenues of 926 crores and profit before tax of 227 crores. The business contributed 33% to our group's PBT for the first half. PAT from this segment reduced to 144 crores as compared to 155 crores for the first half in FY18. The AUM of our wealth management business stands at approximately 44,000 crores, excluding custody assets. The equity AUM has increased by 2% year-on-year and stands at 11,400 crores. Our average daily turnover has increased to 6,046 crores during the quarter, which is up 27% year-on-year. In our alternative asset management business, our AUM stands at approximately 800 crores. The loan book for this segment is at 8,176 crores, which registered a growth of 23% year-on-year. The gross debt equity for IWS segment stands at 3.81 as of September 30th. The net debt equity is at 3.38 times for the same period. Moving on to the second group vertical, which is the mortgage lending business. For the first half of FY19, the segment had revenues of 613 crores with a profit before tax of 259 crores. The business contributed 37% to our group's PBT for the first half. PAT from this segment grew to 82 crores for the first half of FY19. The loan book stands at 8,792 crores, which is an increase of 54% year-on-year. The gross debt equity for mortgage lending stood at 2.46 times as of September 30th, and the net debt to equity is 2.2 times for the same period. Moving on to the distressed credit business. Our AUM for September 2018 has grown by 14.34% year-on-year to 14,257 crores. JM Financial ARC's contribution to the security receipts stood at 3,200 crores, which is an increase of 84% year-on-year. For the first half of FY19, the segment had revenues of 283 crores with a profit before tax of 160 crores. The business contributed 23% to our group's PBT for the first half of FY19. Profit after tax from this segment grew to rupees 51.55 crores for the first half of FY19. The debt equity for distressed credit segment stood at 1.68 times as of September 30th, 2018. Moving on to the last, an asset management business comprising of a mutual fund. For the first half of FY19, the segment had revenues of 51 crores with a profit before tax of 32 crores. The business contributed approximately 5% to our group's PBT for the first half, and PAT from this segment grew 14.3 crores for the first half of FY19. The average quarterly AUM of the mutual fund stood at 12,672 crores, comprising 8,400 crores in equity schemes and approximately 4,200 crores in debt schemes. With this brief update, I will now request Manish Sheth, our Group CFO, to present the group's financials.
Thank you, Vishal. Good evening, everyone. Before I present these financials, I would like to bring to your notice that any forward-looking statements made on this call are based on management's current expectations. However, the actual result may vary significantly, and therefore the accuracy or completeness of this expectation cannot be guaranteed. Now let me take you through the group's results, which were announced yesterday and are available on our website. In Qtr2 FY19, our revenue grew by 27% year-on-year to rupees 975 crores from 770 crores. The Qtr2 FY19 PBT is at 380 crores, which is an increase of 20% year-on-year. Our Qtr2 FY19 PAT grew by 8% year-on-year from rupees 151 crore to rupees 163 crore. During the quarter, there was an impact on MTM, which is negative of 23 crores in our profit after tax. If one were to ignore this MTM for the quarter, PAT would have been 178 crores, which is a growth of 18% quarter-on-quarter. We conservatively take all mark-to-market through profit and loss account and not reserves. MTM is of rupees 20 crore. In the equity shares of NITCO is being provided, which is held by one of our group company, JM Financial Asset Reconstruction Limited. With regard to first half-year numbers for FY19, the gross revenue is 1,830 crore and a net consolidated profit is 306 crores. This represents EPS of 3.65 versus 3.49 for the same period last year. As on 30th September 2018, the net worth is at 4,923 crore, which is a book value of 58.63 per share. In the first half of FY19, the revenue increased 22% year-on-year to 1,828 crore. The group's finance cost has increased to 716 crore versus 539 crore during the same period, primarily on account of increase in borrowing, which was 12,400 crore, has now increased to 7,800 crores. Our cost of funds stood at 9% as compared to 8.7% year-on-year. With this, I would like to conclude and we are happy to take any questions. Over to moderator, please.
Thank you very much. Ladies and gentlemen, we will now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on their touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. The first question is from the line of Dhruvesh Sanghvi from Prospero Tree. Please go ahead.
Yeah. Hi, sir. I have some questions related to the overall classification of loans. So, I'm getting confused about 17,000 crores of loans categorized as wholesale, retail, capital market, and corporates. And on the other side, when we see JM Credit has a loan book of, there's a lot of noise of paper coming. Hello?
Hear us?
Yeah. On the other side, JM Credit has around loan book of around 8,700 crores.
Right.
And JM Products has 7,800 crores. So can we have some kind of a match the following concept here, because it becomes very difficult that which loan is given from which part. I'm assuming that JM Credit is giving only the wholesale part and JM Products is giving the other aspects, but if you can just help us understand how should we look at it.
Sure. So let me explain to you how this works, right? So ignore Ind AS for a second. Last year, we basically had two NBFCs in the group, right? We have JM Financial Products, which is largely our capital markets, corporate lending, and retail lending NBFC. And we have JM Financial Credit Solutions, which basically does wholesale finance and largely to real estate developers, right? And there are obviously loans. The single borrower limit of JM Financial Credit Solutions was approximately 150 crores. And there will be loans which are larger in size, and therefore we were underwriting those loans in JM Financial Products. So, for example, if you have a loan of 250 crores to a certain client, then you book 150 crores in JM Financial Credit Solutions, and the additional 100 is being booked in products. And therefore, we give you the classification by wholesale mortgage, by capital markets, by corporate lending in a separate breakup, so you can tell what is in products and what is in credit solutions if you do the detailed breakup. Now, in Ind AS, what has happened is that we have to segment on how we look at the business, right? So the real estate and mortgage origination business sits in JM Financial Credit Solutions. Products is only assisting them in terms of single borrower limits and taking a pro rata share or share of the loan after JM Financial Credit Solutions has exhausted that single borrower limit.
Right.
Now, last quarter, we have done a significant fundraising in JM Financial Credit Solutions of almost 875 crores.
Right.
And also, over the last 2-3 years, JM Financial Credit Solutions has reported very healthy profit growth. And therefore, the single borrower limit every quarter has increased. And with this fundraising, it has significantly gone up. So going forward from this quarter, we do not anticipate any more real estate loans to be booked in JM Financial products. They will be concentrated and booked only in JM Financial Credit Solutions.
So then can we say that entire wholesale can be mapped to the JM Credit Solutions?
That is right, because wholesale mortgages, I would say, should be mapped to JM Financial Credit Solutions. They also do a bit of corporate lending and promoter lending, but they are primarily wholesale mortgage driven, and that is right. That would be mapped to JM Financial Credit Solutions. In JM Financial products, you will have different classes of loans. You will have some old loans in the real estate segment which were booked in partnership with JM Financial Credit Solutions, and that book will reduce over time. But you will have largely capital market loans, you will have margin trade finance loans, you will have loan against shares. JM Financial Home Loans is a subsidiary of JM Financial Products, so they are providing the capital for the retail mortgage loans, for the SME loans, as well as the corporate lending and the loan against share business. So that will be the
that is done through that subsidiary.
Sorry?
That is done through this subsidiary that you were saying.
That is right. That is right.
Okay, so the gap figure, basically, let's say the total loan book is 17,000 crores, and if I just add the JM credit and products, it is turning out to be around 15,500.
Yes.
So around 1,600 crores is given out of that subsidiary of home finance is what you are saying.
Yeah, there are two subsidiaries. There is JM Financial Capital and JM Financial Home Loans.
Right.
Both are 100% subsidiaries, and they do the same business as JM Financial Products. It is only because of capital efficiency they've been capitalized and promoted separately.
But none of the capital market funding will be done via that home subsidiary, right?
No, zero.
So what is the current number for capital market funding then?
So capital
about that entity particularly.
Yeah, so capital market funding in total will be around 2,600 crores in both JM Financial Products and JM Financial Capital put together. And there will be roughly another 800 to 900 crore exposure in the broking entity, which is JM Financial Services. So the total capital market will be around 2,600 plus 800, so roughly say 3,400 to 3,500 crores.
But then in the presentation, the capital market number is being shown as 2,472. So where is this other 1,000
because the balance number is in our broking company. It's not in our NBSC. It's not technically a loan book. It is basically financing for the broking clients on a very short-term basis because of the pain, right? So that is where we borrow very short-term commercial paper. Clients could be doing cash futures trading, or they could
So that is not even considered as a part of this 17,000.
No, that is actually, so that is what you should understand, because when people say that we have commercial paper borrowing, right, our commercial paper borrowing is actually being used for a working capital activity. Almost. And these are, and most of this commercial paper actually is investments in fixed deposits also, which gives us lines from the exchange to do business. So that is why we don't confuse that 800, 900 crore number in our loan book.
Okay. One additional over that, I mean, just to conclude. So when we come to the slide known as IWS Key Financial Information, actually my slide number is missing because I am seeing the prints, which has basically the details about wealth management, AUM growing, and some numbers below that.
Yeah.
Why are we showing the loan book data out here? I mean, what is the logic to show loan book data under IWS?
Yes, because IWS has both businesses. It's got fee-based business and fund-based business. Because I'll explain to you. So a lot of the clients who are giving us fee-based business, they also do loans business with us. Not all, but many of them, right? So let me give you an example. So there could be a client who is borrowing from us and on margin loans and giving us broking business. So, it is a very close relationship between the broking business as well as the lending business.
No, so what kind of lending would this qualify to in that wholesale, retail, capital market and corporate categories that we are defining?
So this is actually, it's all retail margin loans. I mean, this is not really wholesale loans, and they're very short-dated loans. Some loans are as short as 30 days, and some could be as long as 90 days.
8,000 crores.
Sorry?
but this number is 8,000 crores.
No. This is the total book, right? Because in this book, as I said, we also have corporate lending, right? We have promoter lending, we do promoter loan against shares, right?
Okay.
So, and then we also have the book which we had built along with JM Financial Credit Solutions, right? Because that is staying in JM Financial Products.
No. So my actually, I was indicating that, what it looks like that when we show loan book out here at 8,200 crores or 8,176, it gives us questions where is the interest income of this 8,100 crore being booked into IWS, which is not the case. The entire 8,100 crore interest income is not coming under IWS.
Correct. So that is a good point. But that book, which is the real estate book, which is a component of that, is the only component which is reducing quarter on quarter. You see.
Okay. So
that's why we spoke to our auditors earlier this year, and they said you decide where you want to classify it. Now, it is very difficult to take it out of JM Financial Products entity and put it somewhere else. So we said anyway it is reducing because JM Financial Credit Solutions are doing more wholesale business. That's why we left the loan book here, and that's why there is a separate page where we actually give you the data of what is the wholesale mortgage book, what is the capital market book, and what is the corporate book.
Okay. I have one question on this same thing. When we say this wealth management AUM has increased from Q4 to Q1 by 11,000 crores, like suddenly did we get some extra clients? And is this the wealth management where we keep earning some distribution margin, or is this something else?
No. We have not increased AUM by 11,000 crores quarter on quarter. 11,000 crores is our equity AUM.
No. I'm saying wealth management AUM has increased from Q4 to Q1.
Yes.
Q4 to Q1 from 31,000 crores to 42,000 crores.
Yes, so this is the AUM under advice where we earn fees. That's correct. So that is correct.
We acquire, it looks as if we have acquired some large clients out here.
Correct.
Otherwise, how would this number go? So I just wanted to understand, have we activated a larger team? And what went through that we get 10,000 crores of extra AUM in a quarter? Any thoughts there? I was not participating in the last call if you have discussed, but if some thoughts are there.
No, we can discuss that, but we can repeat it.
So basically, I think what we have done is that overall, we have added the families and we have added some of the corporate clients as well. So overall, our AUMs have grown to that level of 43,000 crores compared to the last this thing. So these are the purely the wealth assets where we are advising actually. As Vishal clarified earlier, these are not custody assets, which means these are not just the assets which are lying in the DP, but these are the assets where we are advising. So yes, we have increased our AUMs by acquiring clients, by acquiring assets from the existing clients.
Okay. In that connection, then why our IWS profits for this quarter are down? I can see that there is this 10 crore provision that we have made, but there is, we have lost out on interest costs as well, it seems. If you can expand a little bit there as well.
No, so interest costs have gone up because a large part of the IWS borrowing is short-term in nature and the interest have gone up, right? So all the capital market loans are all funded through CPs. Okay. So the interest costs have gone up by almost 100 basis points before September 21st. So that's why there is a significant interest in the increase in the interest costs. And the provision number has gone up because of NPA. So that is why these two things
capital market NPA?
Yeah, these are capital market NPA. And in addition to that, also there has been sort of lack of capital market sort of broking as well as activity in this year's first half compared to last year's first half. Last year's first half was a very strong momentum in the capital markets. And you should also understand that in the broking space, a lot of the broking revenue actually is earned in mid-cap stocks also. And the mid-cap stocks have been quite lackluster in terms of performance in the last 6 months. So the broking revenues also sort of have been on the lower side. In addition to that, even our investment banking business, if you see our last 5-year historical performance, it has usually performed much better in the second half compared to the first half. And that revenue also is not very stable in terms of Q on Q. One quarter can be 50% of revenue in 1 year. Right. And therefore, those all of these events put together, they create some variability in the IWS results. So therefore, IWS results is best seen on an annual basis because it gives you a much better and clearer picture.
Thank you. I'll join back with you. Thank you. Thanks a lot.
Thank you.
Thank you. Ladies and gentlemen, in order to ensure that the management is able to address questions from all the participants in the conference, please limit a question to 3 per participant. Thank you. The next question is from the line of Parag Jariwala from White Oak Capital. Please go ahead.
Thank you. See, I have one question. First of all, thank you for putting out the, interim presentation on CPs and how the liquidity and LM are behaving the company. My question is, look, ALM is one aspect where we have done a good job. The second aspect is, let's say overall liquidity goes a bit tight or, the cost of fund increase across the board. Obviously, we are not the primary lender having a very great, in terms of longevity, a very big history. So our cost of fund definitely go up slightly higher than the top-rated NBFCs. My question is, in terms of growth, like you also mentioned in the earlier question that a lot of our loans are short-term. Today, let's say I'm charging 12%, but tomorrow if I'm charging 14%, 15%, I'm just taking a number, is our ability to price that loan remains as it is? Will the good customers move to a better rated company just because of the cost of an advantage? Or that business never happen at all? I mean, promoters may or somebody decide not to borrow against shares or securities.
Okay, that's a good question. So, first of all, our short-term loans are only larger in the IWS segment. If you look at the mortgage lending and distressed credit segment, bulk of our facilities are all long-terms, more than 3 years in maturity. So the short-term loan is a necessity for the IWS business. And your question is a good one. So the first thing is that we will always try and retain our good clients, right? So even if our cost of borrowing is going to go up, we'll be the last ones to pass on the incremental cost of borrowing to our good clients. Now, it all depends on the velocity of how much the cost of borrowing is going to go up. So if you're telling me the cost of borrowing is going to go up by, say, 200 or 300 basis points, then, well, I think at those levels, people will reconsider investing in the equity market, right? Because
I'm just taking examples.
Yes, if cost of borrowing were to go up, then this book, the capital market book that we have will naturally shrink because people will basically withdraw positions and not want to do arbitrage trading or not want to have loan against share positions. So it's a very, it's kind of counterintuitive where, you feel that yes, markets are falling, things are cheaper, but if cost of borrowing is going up, you may not see that much interest in the stocks from especially retail clients when funding costs are high. So, and with this retail client base is a very large base. So these capital market loans are spread across all our branches and they're probably 2,000 in number in terms of loans. So there are lots of loans, right? So, we basically do a check every week on where we want to increase rates and where we don't want to increase rates. And yes, so we will take a margin hit if rates go up dramatically. For our good clients, we'll take a margin hit, but on many of the clients, we'll have to pass on costs here.
Okay, that's very sensible. And secondly, if you can highlight, since the ILFS episode, when the market started going down, how much we have borrowed from banks as well as from the open markets? Yeah,
so I think we've borrowed totally around 750 crores from the markets, and we have repaid roughly 1,850 crores since that episode. So the net is a repayment number of around 1,100 crores.
Okay. And this borrowing came in at what price?
The borrowing would have come in roughly at 50 to 100 basis points above where we are borrowing before September 21st.
Which is like 9%?
Yeah, that's right. 9% for short term and for longer term closer to 9.75 to 10%.
And lastly, have we done any reassessment so far as the growth forecast is concerned, both for solution as well as the other business?
I think it's too early to do a reassessment of where growth will be over the medium to long term. As you would imagine that this entire liquidity event is only 4 weeks old. And while we think it's quite temporary and hopefully over the next 4 to 6 weeks things should get much more clearer, I think the right time to make an assessment would be 4 to 6 weeks down the line. My personal feeling is that things should be getting better over the next couple of weeks. There is obviously a lot more nervousness, and people get more bearish when they see many WhatsApps and they hear many rumors. And I think many of the rumors are unfounded, and people should really do their work, read balance sheets, read how companies are doing, look at their debt equities, look at the quality of management, and then decide, how they should be looking at the market. So I think next 4 to 6 weeks, we will still watch, and then we will decide if we want to recalibrate or not. But if I were to answer the question, I think we will see as a group, we've always maintained that a 15 to 20% growth is a very healthy growth, and if markets are conducive, we'll pull the growth number up to 25%, maybe even 30%. And that's been our stated stand for a very, very long time. Correct. So I would not at this point deviate from the stand that we will grow 15 to 20%. I think we should be very easily be able to grow 15 to 20%. Now, will we pull that number up to 25, 30%? I think we'll have to wait and watch before I answer that question.
Sure. And very last, is it possible to get some, granular detail on the real estate book in terms of names and etc.? Because a couple of companies in the competition have started putting it out.
Yeah, so I'm happy to have Gitanjali give you some of those names, but I'd like to say that I think I would say that we have one of the best asset quality books on the real estate side. I would imagine our diligence standards and the way we underwrite, just like private equity, are highest in the business, and we are extremely confident of the performance of our real estate book. I'll pass it on to Gitanjali, who heads our nationwide origination. She'll take you through the top 10 names that we have in terms of exposure.
Sure.
Hi. So with regards to the top 10 exposures which we have in the sector, that constitutes about 30% of our entire portfolio. In terms of the names, I'm obviously saying in the order of starting from the highest. The first 4 exposures are Bangalore-based clients, which are RMZ, Adarsh, Embassy, and Divyasri. So followed by a Mumbai-based developer, one of the largest, Kalpataru, which is about 470 crores. Post this, we have a Chennai client, Casa Grande, which is one of the largest developers and the fastest-selling developers in that city. The next is a Pune-based developer called Goel Ganga, which is a Goel Ganga group. Again, followed by a Chennai developer, SPR. And then the following 2 clients are Spenta and Neelkant, again 2 Bombay-based clients. So this constitutes our the 30% I was talking about of the entire wholesale lending book.
Okay. Thank you, Vishal, for such comments.
Thank you.
Thank you. The next question is from the line of Sunil Tirumalai from Credit Suisse. Please go ahead.
Hi, thank you. Good evening, and thanks for the list that was just read out. Gives us some comfort on that. Sir, I have a few questions. So just going back actually to the loan book split, I mean, even when this happened last time as well, we couldn't clearly understand. So if you look at slide 11, 17,108 crore. Right. And if we go down to slide 20 in mortgage lending, you have 8792.
Yes.
And then slide 19 says 8176. So that comes to about 16,950 or close to 17,000 crore. I'm guessing these are 2 adding up to the first 17,000 that I pointed out to. I just want to understand how these are. Right. Yeah. So where is each bucket going in? I mean, what is going into IWS 8176 and what is going into, because the mortgage number of 8792 is actually less than what you disclosed as wholesale mortgage. So is it that all of the mortgage loans from financial products is in IWS?
No, I'm actually lost with your question. Can you repeat that?
Okay, so I just want to know how the 17108 is slide
17108 is total loans, okay?
Right.
Now, 11211 are wholesale mortgage loans.
Yeah.
Okay. Now, in the wholesale mortgage loans, you take the entire JM Financial Credit Solutions number. Okay. So, when you subtract that JM Financial Credit Solutions number, you will get to a net number, which is the wholesale mortgages sitting in JM Financial products.
Correct. Yeah.
So, that is the number you have to deduct from the JM Financial products book to arrive at the non-real estate number for JM Financial products.
Understood.
Understood?
So this, yeah,
it's
so this difference
as simple as that.
Yeah, so this difference of about 3,000 or 2,500 crore.
Yes.
Is sitting in slide 19 IWS.
That's correct.
What else is there
in the 8176 number you see in slide 19?
Yeah.
That includes that mortgage book sitting over there.
Yeah. What else is there in this 8176?
So now you go back to the same slide where you have the loan breakup.
Yeah.
You have the 2472 and the 2977 and the 499. There is a large part of those loans sitting in JM Financial products.
Yeah.
And the same loans we have in JM Financial Capital, which is a 100% subsidiary of our broking business, which only has capital market loans.
Right.
You get it? So that is that number is split between the net number of products and the total number of capital. Got it?
Okay.
Yeah.
Okay. Now, coming back to slide 19.
So, Sunil, this is all, the reason to do this is to use capital efficiently, right? Because our broking business had almost 225 crores of surplus capital. So we had two choices. We could have used that capital and given a dividend, but by giving a dividend to the holding company and putting that capital back into JM Financial products, we would have lost dividend distribution tax.
Yep.
So we went to the Reserve Bank of India and took their approval that why can't we start a NBFC and invest this 225 crores into a new NBFC only for capital market lending, so we don't pay dividend distribution tax by just transferring the holding and instead of creating a cross-holding.
Right.
So this is all very efficiently managing your capital.
Right. And I missed something on slide 19. Just wanted to clarify. So the net revenue of 473 crore.
Yes.
Does that include the interest income that comes from the 8176 loan book?
Yes, absolutely. This is net revenue on your loan book and your fee book.
Yeah. So so can you just split the fee income and the net revenue and the interest income in this?
Yeah, we'll give the number to you.
Yeah.
Just move to your next question. My team will give you the number in 2 minutes.
Yeah, sure. Secondly, there is this, below the loan book chart, you mentioned the credit solutions was very close to the debt equity limit. So I'm guessing now that's resolved.
That is resolved because we raised equity in the middle of September. So we've raised 875 crores and we've increased the balance sheet size of credit solutions by almost 50% on the net worth side. So our current debt equity stands at around 2 times. So there's enough room for credit solutions now to grow.
Okay. Was a constraint on single borrower exposure sizes, or it's just that you just couldn't, lend more?
No, we couldn't lend more because we have a self-imposed debt equity cap of 3.75 times in JM Financial Credit Solutions. So we hit that cap in July.
Right.
So around July 15th, we hit the cap. So we had almost predicted that. So we had started our fundraising efforts in May, which concluded in middle of September.
Okay, got it.
But now with the net worth going up, we are not going to be booking any more real estate loans in products. All the real estate loans will only be in credit solutions. If you remember, we had discussed this in person.
Yeah.
And I told you once we expand the net worth of credit solutions, we will be able to book all the real estate loans only in one entity.
Right. And slide 13, this is very helpful, giving us a segment-wise breakdown of where the CPs are sitting.
Correct.
My question was on the corporate lending.
Yes.
So the 1,400 crores over here is almost half of the loan book of what you disclosed as corporate lending in the earlier chart.
Correct.
Are these really such short-term loans?
Yes, because I explained to you that almost half this corporate book is actually promoter loans and LAS, we classify it as corporate lending because this works very closely with our investment banking team. Right? So almost all of these are less than, say, 6 months to 1 year loans. They are really promoter loans from a 6 month to 1 year perspective. And they are all top-notch quality loans, right? So they are, I would imagine, 80% of this book is BSE 200 companies. Almost 50% of this book will be BSE 100 companies. So these are, these are actually not even very high yielding. They are around at 11.5. And, very honestly, I mean, if I were to call these corporates and tell them just get these loans refinanced, I can guarantee you half of this will get refinanced in the next 7 days.
Right. And, and on the same...
So your question on the split of 473 crores.
Yeah.
The interest income is roughly 270 crores. Fees and commission is roughly 203 crores. And the breakup of fees and commission is roughly 50 crores in brokerage and other fees is 150 crores.
Understood. And I had a query on the distressed asset, business as well. So over there, how are you, kind of seeing your AUMs? I mean, it's been kind of flattish. I think there were some acquisitions in this quarter. But, any color in terms of how you're seeing the pipeline?
So I think that's a good question, Sunil. So I think the AUM, Sunil, has been flattish, but our underlying investments have almost grown at 50%. And the reason is because that business is moving to a very quick cash investment model. Right? So the 1585 structure is no longer very popular with the banks when they want to close acquisitions. And it's moving very quickly to a cash-only. So most of our transactions which we are seeing, whether small, medium or large, they're all moving to a full cash situation. We kind of prefer that also because the acquisition price is a lot better when we are doing full cash compared to doing the 1585 structure. So, our investment has obviously gone up phenomenally. You would have seen the strong profit growth in the ARC. So the ARC continues to do very well because a lot of our mature AUM is now coming to pay off. And I expect that trend to continue over the next few quarters. So it's a great time for the ARC. It's a great time to do asset acquisitions and also a great time to be able to realize profitability and cash flow from investments made over the last 3 years. I'd also like to address, we have 719 crores of CP borrowing in the distressed credit side, and we are highly confident of recovery over the next 6 months. I mean, we have a lot of assets, not just one, but almost 4 or 5 assets which are in the final stage of resolution. So even if 50% of those resolutions were to go through, we're going to be sitting with a lot of surplus cash in our ARC. 50%
is 1 year CPs.
Understood. And, sorry, my final question is, the SBI chairman made a statement that, they'll be stepping up purchases of assets from NBFCs and some other banks have said that as well. Is that something relevant to you? I mean, are you actively engaging with some banks?
No, so far we have not engaged with anybody on asset sell downs. So we've not discussed loan sell downs with anybody. I think, as you can see, our net debt to equity as of October 25th is very close to 2 times. So we barely have any leverage. Second, because a lot of our equity is invested in these loans, our bankable assets are very large. So the most important thing for us is just to get bank loans from banks. Yes, the banking sector seems to be very attracted by buying NBFC assets because they rather buy NBFC assets at 14% yield than lend to NBFCs at 10%. But that we'll have to see. So I think there are a lot of other NBFCs, friends of mine, who are offering those assets. But I think we will prefer to stick with borrowing as of now.
Okay. Great. Thank you very much, sir.
Thank you.
Thank you. The next question is from the line of Ritika Dua from Elara Capital. Please go ahead.
Yes, so thanks for the opportunity. Most of them have been answered. One clarification, sir. I missed your comment. You mentioned something about NITCO in your opening remarks. If you could just share.
Yeah, so, our net profit for this year, if you see, has grown around 8%. So let me explain to you that in our ARC, we have a stated strategy that we will be taking equity positions in the turnarounds that we like from a long-term perspective, right? But what we have done in Ind AS, we have chosen to be more conservative. So we had two choices in front of us in April. One was that any deviations in the value of your investments can be adjusted into your net worth, or you mark to market them on a quarterly basis. And we have chosen to mark to market the same on a quarterly basis. So NITCO is a output of a restructuring exercise we have gone through with a bad asset, and we have a 29% equity stake that we have acquired in that company. It's a listed company. And in the last 6 months, the stock has come down by almost 65-70%. And, we are very long-term shareholders. We are happy to hold that stock for 3 to 4 years and work through the turnaround of the company. But because the stock price has come down, we have taken a mark-to-market investment hit for the quarter in our books. Now, this is not an operational hit. So our operational profit, if you were to ignore this mark-to-market loss in the ARC, is 178 crores, and therefore our PAT YOY has actually grown by 18% and not 8%. This is what we were trying to clarify.
That's helpful, sir. Sir, on going through the, you mentioned that in your IWS segment this time, we have taken some provisioning hit because of NPAs. Could you clarify on?
Sorry, it's not NPA. It's actually ECL provisioning. It's ECL, so it's expected credit loss based on your probability of default. So it's not an NPA. I apologize for mixing that up.
Sure, sir. And if you could just maybe explain a little bit more and how has this come by? And similar to this, what I noticed is that while the disclosure on the number of the top builders is very helpful, but then the SMA2 accounts for us has doubled on a quarter-on-quarter basis.
Correct.
What is your view on that, and also resolution on one of the accounts which probably the only one which slipped maybe last year?
Yeah. So let me first start with the SMA accounts. That's the most important question. So if you see the same page on page 11 where we've given you the SMA accounts, if you see quarter 1 FY18, the SMA2 was a 0.3% position, right, last year. And last year, the same SMA2 position in quarter 2 moved to 1.9%, right?
Sure.
And you see quarter 1 FY19, the same SMA2 position has moved down to 0.7%. which is again moved back to 1.4%. So what happens is, in our construction finance portfolio, we get interest payments from the escrows which we receive based on sales, right? So many a times there are delays in terms of sales or delays in terms of receivables from home buyers that accrue into the escrow of the person we have lent to. And therefore, he's not being able to pay interest for a month or 2 months. As soon as the situation corrects and he gets the receivables in time, the payment comes through. And therefore, we always see a fluctuation in our SMA2. And, we've been very transparent and we give these SMA2 numbers to you. What we track is internally that our gross NPA should not cross 1.5% and our SMA2 number should not cross 4%. If these two numbers reach those levels, then we get worried. So I think at these levels, there is really no cause for concern, because we are actively working on making sure that the developer from a monitoring perspective is collecting the money and the escrows coming back to normal. And we are also very careful when we disburse construction finance, right? So we are measuring how sales is happening, how much construction finance he needs, how has the building progressed. Every month there is a visit from risk or the origination side. Pictures are taken of the site. So it's very much linked to our monitoring plan here. So I wouldn't stress about it at all unless you see the SMA spike to 4%. Also a concern would be if there is continuous high SMA2 for 1, 2, 3, 4, 5 quarters, right? So that is a bad sign, because that means you are actually releasing construction finance money, but you're not seeing sales. And it's really your construction finance money which is taking care of your SMA2 payment and not making your account an NPA. So that is important. And at JM, we don't follow any of these practices, right? We really follow on making sure we push the developer to sell.
So just on that ECL mechanism, so the reason why this quarter we had a higher provisioning in credit solution is because the spike in SMA2 maybe?
Yes, of course.
So then, so incrementally so does this get reversed incrementally as and when this number comes down?
Absolutely. So the SMA2 comes down, say for example, back to 0.7% as it was in Q1 FY19, the ECL will go down.
Sure, sir. And sir, the explanation on IWS ECL, please.
Yeah. Manish, you want to explain the ECL provision in IWS? I think it works the same way, right?
It's the same way. So,
it's the same way. Sorry, go ahead.
So we have a model where we take PD and LGD. PD is been taken from one of the rating agencies' published data, and we have a LGD where we have asset cover. It is linked to the asset cover. So if it is less than 1.4 time asset cover, we actually kind of take 65% for real estate loans and 65% for corporate loans. Between 1.4 to 1.6 time asset cover, we take 50% for real estate loan and 60% for corporate loans. And if asset cover is more than 1.6 times, we actually take 25% LGD for real estate loans and 30% for corporate loans. And this is being followed, consistently quarter on quarter. So, Ritika, the question which you asked, that if ECL gets reversed, answer is yes, because we don't change model. Only thing the input, based on SMA1, SMA2 undergo a change.
Sure, so that's helpful. And so, sir, again, sorry, getting back to the ECL on the IWS segment. So, which portfolio has resulted in this spike in provisioning? Because IWS has financial products which has 2-3 segments, like the corporate segment, the capital segment.
Yes, there is a corporate segment. There is a 14 crore loan we had against Videocon shares. So that has created the spike, which has been now declared as NPA.
So, sir, if I could maybe ask one more question.
Yeah, please, go ahead.
So your view on margins, please.
That's a good question. You've seen a 50 to 100 basis points expansion in our interest costs in the last 4 weeks. And I think, we so far have not moved very aggressively to pass on the interest cost to people who borrow from us. And the reason is I think we have a very high quality book, extremely high quality, asset side. And I think if we aggressively push the rates onto our borrowers, we may have asset repayments. So let's see how this continues. I think if rates continue to go higher from these levels, then I think we'll have to selectively work on the asset side and increase rates. Our various teams are already working on the same. We are quite ready to move on the same if we have to. But I think for the next at least 4 to 6 weeks, we'll have a wait-and-see approach because we don't want to have a knee-jerk reaction with our clients. And we think this is a temporary phase of liquidity and not really a phase where people are going to be insolvent. And therefore, we should have a wait-and-watch approach. I think these questions will be a lot better answered 4 to 6 weeks down the line.
Sure, sir. I'll come back for a follow-up. Thanks so much.
Thank you. Before we take the next question, we'd like to remind the participants to limit their question to 3 per participant. If time permits, you may join the question queue for any follow-ups. Thank you. The next question is from the line of Manish Bhandari from Vallum Capital. Please go ahead.
Hi, good evening. My question relates to the previous question on the margin side. So looking at the changing scenario in the construction financing side,
right.
When do you see yourself, the capital what you have raised and leveraging that capital, and do you see an opportunity where for you to deployment of that capital should be far easier than the conservative profile what you have maintained in the last 2, 3, 4 years or so?
Yeah, so I think first thing is that we will continue to maintain a conservative profile. I think we've always said that, a 20% growth number is a very good number for us. And if, risk is conducive, we'll take it up to 25, 30. And if risk is not conducive, we'll take it down to even 10% or 15%. And that is our stated philosophy over the last many years, and you know that. And I think we'll continue with the same philosophy. Having said that, I think we are sitting in a very enviable and good position right now because our debt equity is the lowest among all NBFCs in India. We've raised almost 1,400 crores of equity capital in the last 9 months. And our real estate NBFC, the net debt to equity is almost 2 times. And I think let the situation settle down over the next 4 to 6 weeks, and I think we will be in a good position to be able to grow. I think even if you focus on our liquidity statement, which we've given out on October 5th, right? If you just look at the gross cash accumulation which our business will generate by just keeping the assets where they are, because in our presentation we have not talked about what new disbursements we are going to do. So, as an equity analyst, if you just simply focus on page 5 of that presentation and see what is the kind of cash we could be sitting on without new disbursements by the end of March 19, the number is a staggering 3,500 crores odd number. Obviously, let's see how the markets play out, but we could have a very advantageous Jan-Feb March quarter, but I don't want to say anything in a rush. Things are obviously tight from a liquidity perspective for the NBFC sector today. I'm hoping things get better in the next 4 to 6 weeks, and once they do, I think it'll be a better time to talk about it.
Is it fair to assume so that you would go to a peak of 3.85 times, which is your internal limit, with this kind of capital raising?
I think we are quite far away, right? Because our overall net debt to equity is just 2.3 times. We'll be generating a lot of profit over the next couple of quarters. So I think we are quite done with fundraising for our financing business for the next at least foreseeable 2 years. We will need more capital in our asset reconstruction business. There are a lot of growth opportunities there. And we are working on plans to how we raise equity at the ARC level. And I think we will go public with those plans in the next few weeks.
My last question is regarding the asset reconstruction business. So you said that the situation has changed a lot and better for you from the position of the cash flow. So whether this business will be a lot more less cyclical, and how would we should see this business if we have to look at maybe next 3 years and 4 years or so?
Yeah, so, I think, I don't think, in a growing economy, I don't think this business can really be less cyclical. It's actually the right word for this business is it's counter-cyclical, right? So in any growth economy, when there is a lot of growth, there are bound to be bad assets and NPAs created. Today there is a large opportunity because of bunching up of assets coming together. And why did the bunching up of assets happen? The bunching up of assets happened because many of the banks were allowed to restructure loans and postpone their problems. If the banks 6-7 years ago were not allowed to restructure loans and they were asked to make those loans NPA, then the growth rate of ARC would have been much more measured over the last 7-8 years compared to a very high growth rate that you're seeing today. So yes, the growth rate of ARC will taper, but maybe after 2 to 3 years. I think for the next foreseeable future, there is going to be quite a high rate of growth for the ARC business.
Thank you.
Thank you. The next question is from the line of Anand Pavnani from Unifi Capital. Please go ahead.
Thank you for the opportunity. I have 3 questions. I'll ask sequentially.
Yes.
So you mentioned about repayment of 1,100 crores, net repayment of 1,100 crores. So just wanted to understand how much of this was prepayment, if you can give the breakup.
So you mean asset side repayment?
You mentioned about liabilities. So
the CP side. Yeah, so we basically bought back roughly 865 crores of our CPs in the last 2 weeks.
Yeah.
And I think we bought back all our maturities up to November 14th or November 28th in certain companies. Because we don't want to sit on negative carry, right? So if you're sitting on cash, we would much rather purchase the CPs. But the challenge is that not everybody is selling our CPs, which is also a good sign. But it's also a bad sign because sitting with all this cash, we're going to be earning negative carry. So wherever possible, we are trying to buy CPs, and we will continue with the same plan next week as well as week after next.
Sir, generally these times are very opportunistic time for deploying cash at very high yield. So having bought back CPs, it seems that we are going ultra conservative. Like, am I thinking right? We already have enough money to lend, and then we have reduced by our overall capability to lend further by buying back our own papers? So
that's a great question, but we are a very conservative company.
Okay. Second question is about the TER cut for distribution of mutual funds. Asset wealth management is a big business for us, so if you can give me a ballpark sense of how much our PBT will reduce on a consolidated basis due to this TER cut.
Yeah, between 10 to 15 crores.
10 to 15. And third, sir, I understand it would be difficult for you to assess, but given the stress in the system and given the fact that we are not aggressively lending at this moment, do you anticipate that H2 for us would be weaker than H1 ballpark?
So I can tell you that Q3 will be weaker. Difficult to comment on Q4 because, if things normalize in, say, the next 2 to 4 weeks, most mutual funds we talk to are waiting to cross November 14th. So I don't know what the magic number on November 14th is, but I believe that a very significant part of the CP repayment is due in the first 10 to 15 days of November. And if those CP repayments happen on time and there is no default, then I think the system may come back to normalcy quite quickly after that. So that is why I said that let's wait out 4 to 6 weeks. There's no rush. We are building this business for decades and not for the next quarter. So let's wait and watch and decide after 4 to 6 weeks. Things come back to normal, then I think it's pretty obvious that, with our current debt equity, our current levels of cash, our current power in being able to originate high quality assets, both on the real estate corporate as well as on the capital market and now on the retail side, we will be in a very good position here. Only one weakness is that we are going into an election. So our investment banking as well as our capital markets business may slow down a bit because it gets difficult to close transactions during an election period. There is uncertainty, M&A slows down, IPOs slow down, and that is almost 200-250 crores of revenue for us on an annualized basis. So that obviously we'll have to look at on how that pans out. But that is obviously an event we'll have to see in May, right? Because it's not next week or something. It's, we'll only know in May.
Sure, sir. And sir, just last one question.
Yes, please.
I see broadly the group is very conservative, but there's a puzzling data point that you shared over the call that we lost 14 crores turned NPA for loan against shares against Videocon. Now, Videocon, it's
not 40 crores, not 40 crores. It's 14 crores, 14 crores.
14. Yes, sir, 14 crores. Still, it's a number.
Yeah.
It does, an investor, it raises questions in the mind that such a conservative group can lose money lending to a company whose debt is apparent since last 4 or 5 years. So if you can help me through the thought process, what exactly went wrong?
Yeah, so I'll tell you, this loan is backed by property. It is not just backed by Videocon loan shares. So we were not stupid enough to do a loan only against the shares of Videocon. And we'll have to go through a property SARFAESI action on the property and recover the money. So we are very hopeful that we'll recover all the money once the property is sold. So we are very careful. We are conservative. Conservative doesn't mean you don't take risk, no. You take risk, but you take measured risk. Sure. So here the loan combination was loan against property, and it's a very good property in the city of Bombay and Kalina. In addition to that, we had shares. The share value obviously is very low, but we liquidate the property in the next 6 months to a year and get the money back.
Okay, fine. That's very helpful. Thank you.
Welcome.
Thank you. The next question is from the line of Ritesh Chheda from Lucky Investments. Please go ahead.
Yeah, thank you very much for the opportunity. Just one question. Considering the way situation is, do you foresee a case where there is a probability of an asset price or collateral price downward revision because, we are in a 13-14-year cycle? And if yes, then what will be the stress test on the credit, liquidity, and the solvency of our portfolio?
Yeah, it's a very, very good question. So let me start by saying that our portfolio is again of very high quality and we have utmost confidence in our portfolio. And largely most of our loans are with tier 1 and tier 2 developers. We categorize all the real estate community into 4 zones. Tier 1 developers who are absolutely high quality, who've been in business for over 20 years and have a very long track record of having delivered millions of square feet in that micro market. And I would imagine almost half our book or more than half our book will be with these developers. Tier 2 are similar developers but slightly smaller in size, and that is where we are able to get maybe 100 to 200 basis points better return for similar risk. And that will be the balance of our book. We have no exposure in Tier 3, Tier 4, where the developer's track record is less than 10 years. He's not delivered enough of square feet area, as well as his brand is not very strong. So I think there is going to be a big interplay between the Tier 1, Tier 2 and Tier 3, Tier 4, where if this cycle gets rough, and when I say rough, I assume a 30 to 35% fall in the selling price of homes, which again is a low probability scenario, but assume for a second that scenario does play out, then I think the entire Tier 3, Tier 4 developers will be sold to Tier 1, Tier 2 developers. And the financing needs for people like us will go up because each of these developers will want more acquisition finance to buy out the Tier 3, Tier 4 developers. So I would not like that scenario to happen, but if it does, it puts us in a very good position.
But is there a probability of collateral price revision and asset price revision? What you gave out is the outcome, but is there a probability?
Let me give you an example. Okay, let's think about this. You're going to buy a home. Say you want to buy a home somewhere in Bandra or somewhere in, say, Chembur, right? And you have the following choices in front of you. You go with a broker, and you see 4 developers, 4 buildings coming up in that micro market. There are 2 developers you haven't heard of, and there are 2 developers who are very strong in that micro market or very strong in Bombay and extremely well branded. This is a house you're going to buy for you, your wife, and your kids, and you want to stay in that house for the next decade at least. If a developer who you don't know, whose financing is suspect, the financial closure is not done, is offering you a 20-25% discount on the price, where you know the product may not even finish, would you still buy that house, or would you pay 20% more and buy the house of a developer who's stable, okay, and will complete the building and will give you and hand over a unit to you in top quality? My guess is that 80% of people who are seriously looking to buy a home, and this is already a home buyer market, there are no investors left. Investors in real estate ran away 4 years ago. A home buyer who is serious will pay 20% more and buy a quality home. So when you talk about collateral values dropping, where is the collateral value going to drop is something you have to see. So if, Oberoi or Godrej has properties and if some, low quality developer next to them is going to drop property prices, it doesn't mean that Oberoi and Godrej are tomorrow going to drop property prices to be able to sell. So the stronger developers will prevail, and they will have better sales, and they will get customers, and they will get housing finance at very good rates, right? So it's not just about, collateral damage happening across the sector. I think the markets and, investors, both on the credit and equity side, are just overly nervous, and they're creating more panic in the system than is required. I mean, these things, don't play out really in a home buyer's mind the way investors are making it out to be.
Okay. Thanks for this answer. Just one question more. Do you see incremental financing happening to the space over the next 3 to 6 months?
I think the next 2 months need to be watched out for. But I think things should resume back to normal starting January, February is my guess. That's why we want to wait 4 to 6 weeks. We are in a position to disburse if we want to. We're just being conservative and holding on. Just the way demonetization happened as a company, this is the first time, forget company, I think most Indians for the first time were facing the effects of demonetization, and we did not grow our book for 6 months because we were being very careful. So we will review that. As JM, we will review that 4 to 6 weeks from now. As a market, I don't know. I think the market also, in the other NBFCs and other players are also having a wait-and-watch situation. there will be a few who will take a plunge faster, and there will be a few who will wait. Having said that, I can tell you one thing, that across NBFCs and across HFCs, definitely people are going to be more focused on credit quality and asset quality. And also people are going to be more focused on what rates they lend at. So I think pricing power actually will come back to people who are giving money very, very quickly.
So I'll just ask here, if that's the case where incremental financing may not be, or let's say if it plays out that incremental financing doesn't come after the 2-3 month window which you are highlighting, is it a sufficient enough reason for the asset price revision in few pockets to start?
Yes. If incremental financing does not come through by January, for example, you will see asset prices going down.
Right. So collateral price revision, asset price revision can set in.
Yeah, but it will set in. So I'll give you an example. It will set in more with the weaker credits. And what may happen is if you have more weaker credits in your portfolio, even by reducing your price, you're not guaranteeing sales.
That's always the case. These are price inelastic products.
Exactly. And that is why I'm telling you there will be more M&A between Tier 1, Tier 2 developers and Tier 3, Tier 4 developers. Because the weaker developer who's being able to assess that even if I drop price by 20%, so how is a weaker developer going to sell? He's not just going to randomly wake up one morning and say, okay, mere ko paisa nahi mil raha hai, so now I'm going to cut my price by 30%. It doesn't work like that, right? It's a business. He's running a business. So what he will do is he will basically assess, he'll call brokers, he'll figure out at what price he can sell. He will get frank feedback from people who've been selling his product for a while. And if he realizes that at his brand, if he has to sell 20-30% lower, he rather do a partnership with Godrej or Oberoi and let that guy sell at his price and he gets a share of the revenue. That is why there could be more M&A, and if you talk to all the large players who are cash rich, who are well funded, are actually sitting pretty to take over these assets and do these transactions. Now, if the credit is very weak, and if there are obviously issues in terms of title, issues in terms of what he's trying to sell product, then of course, it's going to be a tough time, But I think that's already priced in, right? It's not that people are looking to sell those projects anyway.
Okay. I think the second phase always is asking for more collateral as soon as the property price revision sets in. The third phase is consolidation. Any guess, that was very, very helpful. Thank you and all the best to you, sir. Thank you very much.
Thank you.
Thank you. Next question is from the line of Ankit Gupta from Bamboo Capital. Please go ahead.
Thanks for taking my question. So, recently, there was a comment from one of the largest developers in Mumbai market.
Sorry, I can't hear you. Hello?
Yeah, hello. Recently, there was a comment from one of the largest developers in the Mumbai market that a lot of the NBFC funding to the real estate guys was for land acquisition. So, if you can, talk about these practices and do we also have some exposure to funding for land to this top developers?
Yeah, so we have 10% of our book is funding against land, and it's with the top quality developers. So all our land funding rates are also sub 15%, and they are with all the top quality developers. We do not do any land funding with even tier 2 developers.
Okay.
I think a comment of this nature is highly exaggerated. I think real estate as a sector doesn't necessarily behave like the power sector. It is a lot more granular in nature. There are a lot more players. You don't find one asset which has 6,000-7,000 crores of investment which can go bad because they don't have a coal mine or they don't have a power. SEB is going to buy power supply from them. So I don't think it is right to compare the real estate sector from that perspective. So obviously, it would suit large developers. I don't know who the developer is, but it would suit any large developer to talk like this because he will get assets at cheaper prices. But I don't think it'll play out as bad as most people think. I think even even in the competition, most of the NBFCs have been quite sensible. I mean, it's not that they don't have collateral cover. They have a lot of collateral covered against where they've lent money. End of the day, I think if you're extremely bearish on India, you're extremely bearish on job creation in India and the economy, and you feel that the economy can, grow at 3-4% and really drop in terms of its growth rate, yes, then there will be challenges in real estate. But I don't think the real estate sector will cause the economy to grow at 2-3% or, a loss of jobs or, whatever you may think, right? So I think I don't think it's as bad as most people are trying to make it out to be.
Okay. And then my second question was on how currently is the situation in the money market. So we have been, hearing rumors about complete freeze of issuance of CPs by even, mid-tier and even high-quality NBFCs. So any views on that? How is that situation? And what is, you are saying that it might improve in the next 4 to 6 weeks. So currently, how is the situation?
So let me tell you, the situation was quite bad in the last week of September, and it actually got a bit worse around 5th of October. So what happens, as you know, that a lot of money leaves the month of September, because of advance tax payments. This time, because of the ILFS issue, a lot of the money left in the last 2 weeks and last 3 weeks of September and was restricted not to the last week of September, right? So there was huge outflow which already happened, which put pressure on funds to sell assets, which triggered the DHFL bond sale on that Friday, getting the market to crash. Now, what happened is there was also an expectation that a lot of the money would come back to mutual funds in the first week of October. And come 5th or 6th October, which was the Friday and Saturday, which is the end of the first week, that money did not return back into the mutual funds. And that caused further tightness, right? Because end of the day, people expected a situation coming back to normal, which happens every year and has been happening for, the last 2 decades, which did not happen this year. So that created more panic in the second week of October. But I think in the last 10 days, things have gotten better. We've been able to raise money. Many of our competitors we know have been able to raise money. And I'm hoping that, post the first 15 days of November, things will look a lot better.
Okay. And how is the situation for longer term bonds, let's say 3 to 5 year bond? Are we seeing any issuances there? And
No, so you're not seeing any term issuances. Most of the money that is available from a 2-month, 3-month, 6-month or a 1-year paper. Beyond 1-year paper, people are not taking calls, and frankly, RBI has given a hawkish call. They did not increase rates, but they gave a hawkish call. That means they could raise rates, maybe in November, December, Jan, if they feel inflation is going to creep up. So when a fund manager has to take a call based on a RBI hawkish view, it will be very difficult for him to go long on maturities in his portfolio here. So that is another action which is, complicating life for longer-term borrowing here. Having said that, we already have a shelf prospectus filed in JM Financial Credit Solutions for doing a public issue of bonds. And after Diwali, we will basically raise money directly from retail, which should give us long-term liquidity and 3 to 5 year money.
Okay. And from the bank side, how is the situation?
So bank side also, there was kind of a freeze in the first 2 weeks of October, but naturally, because, if you see the exposure of ILFS is quite wide. I would imagine every bank, mutual fund, and many corporates in the country have direct exposure to ILFS. I must clarify that at JM Financial Limited, we have zero exposure to ILFS of any kind. So that has made all banks review their NBFC positions. And that review mechanism takes time, right? So there's a board review, there is a committee review, and rightly so, because I think all bank boards and all bank CEOs will be worried. Most banks have almost between 5 and 10% exposure to NBFCs. And that review obviously, would take place, and that's when they'd figure out that who are the better positioned NBFCs, who have low leverage, high quality of assets, better governance, and those will be the NBFCs who will get money faster from the banks. So I think the banks have most banks have finished that process. and they'll finish the process of their quarterly earnings. And I think from the bank side, again, by the first week of November, things should be back to normal. And in addition to that, RBI has been quite helpful in terms of having State Bank of India and some of the other banks, purchase assets of some of the NBFCs, and therefore, especially the highly levered NBFCs, so they can at least get liquidity to be able to meet their short-term commitments.
Okay. Thanks, sir. Thanks. That was very helpful. Thank you.
Thank you.
Thank you. The next question is on the line of Vaibhav Kachoria from BK Capital. Please go ahead.
Hi, Vishal. I wanted to know, do we have a policy regarding buying back our own shares? And any thought on that?
Yeah, so at this stock price, I would love to, buy back our shares, but I think it'll be more prudent to keep liquidity right now. And, as you know, we have a pretty high dividend paying policy. We've been very consistent in terms of dividends we've paid over the years. So buyback is another way of returning capital back to our shareholders, and we will duly evaluate the same. But I think for the next 4 to 6 weeks, I think we would like to stay as liquid as we can.
Right. Is there some trade-off between dividend and buyback? At some price, at half book or something, you might need to consider that, right?
That's right.
Okay, great. Thanks.
Thank you. Ladies and gentlemen, that was the last question. I would like to hand the conference over to Mr. Vishal Kumpani for closing comments. Thank you, and over to you.
I thank all the participants for taking time to attend this call. If anybody has any specific questions or any other concern, please feel free to reach out to our investor relations team. Thank you again very much for participating on this call.